Hi, today we will look at the biggest, most famous company in the world, and as you know from the title, I'm talking about Apple. I don't think I need an introduction to this company today, as I'm pretty confident everyone knows what Apple does, so I'll just get into the analysis. Now, if you are new to my channel, well, welcome. My videos are about investments that anyone in the world can make. I'm trying to help as many people as possible understand what they are actually investing in. See, most people spend more time researching their next computer or phone than they do their next investment. I have built a reasonable size investment portfolio for myself that I am aiming to continue to grow at 20% per year. I based a lot of my knowledge on the great investors, Peter Lynch, Warren Buffett, Charlie Munger, Monish Pabrai, and a handful of others. Now, I know I'm not perfect at this. Not every investment that I make is going to be a home run, but we definitely will find some great investments and push for that 20% goal. So let's get into Apple. Apple has been a fantastic compounding performer over the past 20 years. Any investment 10 years ago would have returned a minimum of 10 times your initial investment. That's nice to think about in hindsight. I actually invested in Apple back in 2012. I held it for a few years, then I sold to invest in my own business. Now, I actually was lucky that my business did better than the Apple stock price, but not by a whole lot. I can tell you now, it would have been far easier to have just invested all my money in Apple. Okay, now we don't have a time machine, so it's all about the current situation and the future of the company. So can we get these impressive returns over the next 10 years? Well, let's try and work that out. Firstly, the Apple brand is incredible. An Apple phone is a status symbol. It blows me away that I'm living in the poorest country in Europe where the average salary is like $500 a month. Yet, most people have Apple iPhones. It is one of the most important purchases someone can make, and Apple is the clear winner. Whether this behavior is smart or dumb, it doesn't really matter. It is the reality that I live in, and I just have to take notice of it. Look, by the way, I'm in Ukraine if you weren't sure where I was. Now, I think how they've added AirPods at such a high price point and made a fortune is a true testament to how Apple's branding is more important than anything else. But it isn't all perfect. They are losing a little market share here. Apple's AirPods sales are projected to reach 82 million this year, even as its hold on the market share decreases. Apple is losing its dominant grip on the wireless earbud market and now holds just a 35% of this fast-growing segment, as per the Q2 2020 report from Counterpoint. But then I can imagine Apple will bring out something new and that will be a huge hit as well. They are just this money printing machine. Now, earnings per share came in at 73 cents versus what the analysts had expected at 69 cents. Revenue also exceeded what the analysts were expecting. Their services revenue was higher than the analysts expected as well, and Apple reported a quarterly record for this services revenue. So from Apple's earnings, another great quarter from one of the most amazing companies in the world. So we should just pour our money into this company, right? Well, not so fast. I want to talk about the law of large numbers. The law of large numbers in probability statistics states that as a sample size grows, its mean gets closer to the average of the whole population. In a financial context, the law of large numbers indicates that a large entity, which is growing rapidly, just cannot maintain that growth pace forever. So now Apple has become the biggest company in the world, and the law of large numbers will most likely now affect their growth rates. Analyst consensus is around 10 to 12% growth per year for the next 5 years, which is still strong. But I think the days of getting 20 to 30% per annum stock market returns from Apple, well, it'll be a stretch with only that 10 to 12% growth. So just don't expect the past 10 years to be a reflection of the next 10 years. Now, it took a lot of time to put this video together, so if you could give me a tiny bit of feedback by hitting the like button for me, I'd be very appreciative. Warren Buffett's Berkshire Hathaway has the largest ownership stake in the company, which I think is a fitting for one of the greatest companies of all time to be owned by the best investor of all time. Currently, Berkshire Hathaway have over 40% of their portfolio in Apple shares, and the buying started back in 2016 when the adjusted stock price was around $25 to $35 a share. Just for reference, the current stock price is well over $100. So that's nearly a 4 times return in 4 years. Well, not bad at all. We know how thorough Warren Buffett is when making an investment, so for him to make such a big play into Apple is a big tick of approval. Now, I think there is nothing wrong with copying the great investors. They have far more experience than most of us and make far more money than most of us ever will. I actually think a very good strategy would be just to get the 13F filings from the best investors in the world, and copy what they do. You would save huge amounts of time researching the companies yourself, and you would likely get close to similar returns to these best investors. Probably the most underrated strategy out there, and something I'm going to be doing a lot more of. There's actually a study, which I'll try to leave in the description, that I read proving that if you just follow what Warren Buffett has done at Berkshire Hathaway and follow his 13F filings, well, you would have averaged over 20% per annum. That is an unbelievable compound rate of return, and you would be just filthy rich. So why don't I do that exclusively? Well, I do copy famous investors a lot, but I want to improve myself. So one day I can be an investor like these legends. And I actually enjoy learning about the investments that I'm making too. In 2012, Apple started buying back shares. That is 8 years now, and that is another reason why shareholder returns have been so impressive. Share buybacks is something I really like to see. Since shares of a company are a part ownership in the company, well, our ownership percentage gets bigger and bigger because the company is taking shares off the market. This is great news for long-term investing and is something that is a big positive. Now, with any business, to check the financial health of the company, we want to look at these 3 areas. Can they handle their debt? Are they growing? And are they a well-managed company? Now, don't worry about the terminology that I'm going to be using here. Just sit back and try to follow along. Look, it's part art and part science anyway. It is really important to look at the company's debt because businesses just can't go bankrupt if they don't have debt. Debt is the reason companies get into trouble. So, to see if the business can handle its debt, I go through what's called the debt to equity ratio and the current ratio of the business. Now, Apple's debt to equity ratio at the moment is a 1.5 and getting bigger. This is far higher than the 0.7 I like to see. But when we take a look at the current ratio, we see that this is at a 1.5. And this means that their short-term debt is actually very manageable. Now, a little later, we're going to look at their huge amount of cash that they have in the bank, which is another reason why we can give them a tick for manageable debt. In the finances, to check for growth, I look at the book value per share, the earnings per share, the operating cash, and their gross margins. Sure, 2020 is probably going to be an exceptional year, so I will think about that when I'm looking at these charts. This is the earnings per share, and there's solid growth here. But I think a lot of this has to do with the share buybacks, as well as the business growing, but share buybacks do affect this number a lot. Now, book value per share isn't growing over the past few years like that earnings per share that we saw. When these 2 graphs don't match, it means that the business isn't really growing, but the share count is declining. Therefore, the earnings per share can look like it's growing, but the book value doesn't. Book value is actually the value of the business. It's a good trick by Apple, but we are smart enough to see what's actually happening here. This is the cash generated from operating activities, and it is growing slower than the earnings per share. Look, this is okay, but it's a sign that the company's organic growth is slowing down. And these are Apple's gross margins, and they haven't been improving. It would be better if this was growing. Now, because they are producing so much cash, they can artificially grow the value of the business by doing share buybacks. Now, this is fine, but Apple has clearly matured, and the law of large numbers is exactly what is happening here. Now, we can't just go and have meetings with the management team and sit in on their discussions. But there are some telltale signs in the financials that tell us that the management team are making some good decisions. So I'm going to check on the return on equity, the free cash flow, the cash on hand as well. So I want to see the return on equity or return on tangible equity above 15, as it shows management are improving the value for shareholders. For Apple, well, it's about 60, which is massive and a big reason why Apple is one of the best companies in the world for the past 20 years. They have a gigantic amount of cash in their bank. It's over $90 billion. They could completely buy out some very impressive companies. For example, if Apple wanted to go into banking, they could just buy Citigroup, literally the entire Citigroup banking business. Or maybe with all this money, they could just continue buying back shares and returning value to shareholders. This is the free cash flow and it's good growth here. This shows that they are producing a lot of cash and it's still growing. Overall, solid financials here from Apple. I would have preferred to see better book value per share and operating cash growth, but the cash pile they have and the cash they will continue to make through free cash flow would be a great business to own. And I also think that return on equity is just amazing. So it's going to come down to valuation. Now, to get a copy of this calculator that will help you find intrinsic value, I have a link in the description and it's free if you want it. Now, when I say intrinsic value, what I'm talking about is based on the growth rates of the company and how much money the company is making. Well, intrinsic value is the correct share price today. It's not perfect because we make assumptions of growth rates, but It just helps us get a ballpark figure. Now, the stock market often overvalues or undervalues companies, and this is just one good approach to working out a good value. So I've used these metrics to find intrinsic value for Apple. I've used the growth rates of 12% for the next 5 years, then it's slowing down to 9%. The discount rate is 8.5. The multiple is 20 because it's such a good company. Now, I've grabbed the free cash flow number here for the next section, and the shares outstanding is there, 50,400,000,000 shares. So based on the growth rate and how much money the company is making, the current intrinsic value of Apple is about $45 a share, and that's with no margin of safety. So I think a better buy price, because we need a margin of safety, well, I think it's at least $30. Now, this is just my estimations. Please play around with different growth rates. If you think things will be better than what I think and what the analysts think, then just try higher growth rates. Just don't forget some margin of safety. No one is going to be able to predict the future exactly, so you just need some breathing room for errors. Now, the current share price, well, I'm in November at the moment, and it's over $100 a share for Apple, so I think it is just very overvalued, even for such an impressive company. Every other valuation metric is showing it is overvalued right now as well. This is the price to free cash flow. It's another valuation metric, and it's the highest it has been for a decade. This is the price to book chart. It's also another valuation measure, and this is also the highest valuation from a price to book perspective for more than a decade. Now we're looking at the PE chart, and it's also the highest PE ratio the company has seen for a long time. Warren Buffett buying in 2016 was a far better time and far better from a valuation point of view. Right now is the worst time to buy Apple shares for probably a decade. So at the moment, do I want to invest in Apple? Look, don't get me wrong, I love Apple. Apple is a great company, but they have matured. I would love to own them, but $30 is where the price starts to be attractive, and I can't see a 70% fall in the stock price. This one is just far too overvalued for me. There is every chance that the stock price returns over the next, say, 5 to 10 years to a PE ratio of 20 and a more standard valuation. Therefore, the upside is very minimal. I would predict that buying into Apple shares at the current price would give only very average returns at best over the next decade. Thanks for staying to the end of the video. Please let me know what you think of Apple as an investment, because I'm very interested to hear everyone's opinions. Make sure you subscribe before you leave, and I'll see you in the next video.